Today we're going to be talking about long-term care with Nationwide. And Jimmy, I'll turn it over to you. Here we got some people still trickling on, so I'll let you introduce Zach, and I think you guys should be able to share screen and have all full control. So thank you, Jimmy. Here's Jimmy Bullock.
Awesome. Fantastic, Tony. Appreciate you having Zach and I on the call, and I appreciate everybody taking the time to jump on today. So Zach has been doing a lot of meetings with me recently, and I think they've been going really well. And then when Tony reached out to me a few weeks ago, he asked specifically for a long-term care training. So that was actually perfect timing, and I was happy to extend the invitation to Zach. So Zach is going to take most of the time today. He is our long-term care, specifically our CareMatters specialist, working with World Financial Group. I think most of you have met him before. He's actually been in the office a couple of times. He used to work exclusively with World Financial Group, but did good enough of a job that some of the other firms wanted to steal him away. So now he just works mostly with WFG. He's very familiar with the business. He's going to go through specifically our CareMatters solution today and how it can help to supplement the IUL business that you are already doing. I think he's also going to talk a little bit about some specific tax advantages with CareMatters, and then cover the long-term care cost estimator. So that's what we have on the agenda for today. I think we're scheduled for an hour. Usually doesn't take Zach quite that long to go through it. So if anybody has any questions, I'll be watching the chat box. You can throw it in there, unmute yourself. Want to make sure that you all are getting as much out of this as possible. So with that, I will pass it over to Zach to take over.
Thank you so much, Jimmy, for the introduction. If I can get the ability to be able to screen share, looks like that might be disabled.
Oh, sorry.
Hey, no worries. Thank you. And thanks for having me on today. Excited to share some updates and different things that we've done. CareMatters 2 is not new. That's our LTC product. We've had our CareMatters product since 2013, but we made some pretty big adjustments to it last May, making it more affordable, more competitive. We're currently priced pretty high, if not I say high, most LTC benefit for the dollar across the industry. So we're seeing sales in CareMatters just really take off this year. It's been a record year for us. To give you an example, with that product, we just hit the same amount of premium that we had come in last year already in this year through the end of June. So we've done as much in 6 months as we did last year in 12 months. If you're not looking at CareMatters, I would, and I'm going to give you some different ways though. If you've looked at the product before in the past, you might think, well, it seems kind of limited, it's expensive. Who do I talk to? It's really almost anybody now that's a good fit, either as their primary LTC plan or as a way to supplement something on the side. So we're going to go through that. I'm going to start with a couple slides to go through. If you have questions, type them in. I'll definitely save time to answer those for you. One is just taking a look at the marketplace and what has happened over the past 10, 20 years. And we see now that 89% of all long-term care sales in the industry are combo. Now, I hate the word combo because it doesn't mean anything to a client. I use the word hybrid. Everybody knows what a hybrid is. Think about auto insurance, things like that. Or I'm sorry, just auto in general, vehicles. What is a hybrid? It's gasoline and electric. And when you think about a hybrid LTC policy, it's long-term care. It either has substantial or at least a little bit of death benefit. And you compare that to traditional long-term care, non-guaranteed premiums, use it or lose it. And we've seen that clients have shifted away from traditional and are looking at these combo or hybrid LTC plans to fulfill their long-term care needs. So CareMatters, it's a linked benefit policy. It kind of has the feel of a traditional long-term care. It has inflation. It's really geared towards the long-term care, but it's guaranteed and there's no use it or lose it risk. So this is a second offering that Nationwide has in addition to our LTC rider. Somewhere between 30 and 40% of all of the life insurance, the permanent life insurance that Nationwide does every single year, the LTC rider is included. So in our industry, that's called a take rate. If you've ever heard take rate, carriers want the highest take rate as possible. It helps the insurance carrier diversify risk by having both life and LTC. Well, what we have is one of the highest take rates, but not when working with every firm, specifically the cases that we place with World Financial Group. Nationwide, with WFG, those policies have the highest take rate in the industry most years, around 40%. So it's a hot topic. Everybody's talking about long-term care now. People are starting to realize it. They're experiencing it with their family. What is the problem? Why do only 10% of people have it? I can't think of a bigger opportunity in our industry than helping those that don't have a plan for LTC get a plan for long-term care. So what is the problem? Why is this such a hot topic? And where is the opportunity? And there's two reasons as you discuss long-term care. For some of you, you may be experienced and you could give me some tips. But my observations, what I've experienced and what I see on a daily basis, there's two challenges that we face. And a lot of times we can get in our own way. If you lead the conversation with long-term care and you're discussing the statistics, the consequences, and the cost of a nursing home, you may be building a wall that you'll never get over. Because for clients, it's scary, it's a big number, it seems unmanageable. And instead of placing some insurance in place and transferring some of that risk, we tend to bury our head in the sand, pretend like it's not an issue. If it's really that bad, I guess we're all in trouble, and nobody buys insurance. So my suggestion is not to start with statistics, but start with the consequences. And these are the words I use. I will say that when it comes to long-term care planning, everybody needs a plan for long-term care. Notice that I didn't say everybody needs CareMatters. I didn't even say everybody needs long-term care insurance, but everybody needs a plan for long-term care. Also, everybody that I know hopes to never need it. And you might not. I might not need it. But if I do, the challenge is that it's going to be devastating on my family. It can be financially devastating, but also physically and emotionally devastating for caregivers. Long-term care is such an important topic. When we look at the statistics of death in the United States, people dying with Alzheimer's or dementia as a factor resulting in death are up 133% since the year 2000. There's a statistic I would use. Not talking about nursing homes yet and how much those cost, but another one that I talk about and how you would start the conversation. 44 million Americans today are caregivers to a loved one. 44 million. Who knows the population of the United States? Anybody? I think it's around like 350. I don't know. I have looked it up though, and I've done the math. And what I do know is that works out to about 1 in 10 people, or 1 in 6 adults. 1 in 6 adults are currently caregivers, providing some care to a family member. Ask your clients, have you ever been a caregiver? Have you experienced long-term care in your family? If you have a story, share it. Also understand that it's probably going to take more than one sale. Not typically something you bring up and they're ready to buy that first day. It might be something where they put you off and they say, no, I'm never going to need it. It's too expensive. I don't know. And it might be 6 months before they come back and say, yeah, we discussed it. We need this plan. What is the number one reason that people don't buy long-term care insurance? 10 years ago, same surveys, same result. The number one reason that people do not purchase long-term care insurance. It's too expensive, right? That's what clients say most often. It's too expensive. So how do we overcome that? The challenge is if you start by showing the cost of a nursing home as your lead, and you tell them there's a 70% chance you're going to need it, and a nursing home is going to cost you $200,000 to $300,000 per year, 20 years from now, which is true, it becomes overwhelming. I suggest starting with a budget, show a reasonable premium up front, get the client to start seeing that the insurance works differently today than it did 10 or 20 years ago, that they can have a reasonable premium, an affordable premium. And then after you start that conversation, once they see the value, then you show the cost estimator. We have a great cost estimator for you to use for that. And that's your leave behind piece. But I would not make it your open up the conversation piece. Doesn't typically work well. So I know I just talked for about 10 minutes on what we probably weren't planning on today. But before we got into product, I just wanted to start with some background on the state of the LTC industry and some things that we often talk about. And now I want to focus on CareMatters too, and some updates that we made last year, making it more affordable. So for that affordable premium, that buy-in, as well as a broader appeal to more people. We lowered the issue age to age 30. So from age 30 all the way to age 70. And we maintained a cash indemnity benefit. So whether it's the LTC rider on an IUL, it's CareMatters, it's all cash indemnity with Nationwide. And we've been that way for 20 years. Well, why are you cash indemnity? And what's the other way to do it? Well, the other way is reimbursement, where it covers any qualified expenses. If you're at home, you're probably submitting bills and receipts monthly. If you're in a facility, you might not have to submit bills and receipts. The facility might do that for you. But regardless, it has to be a qualified expense. Well, 44 million people are providing care to loved ones today, family and friend, informal caregivers. Those 44 million people that are providing that care cannot be reimbursed from a typical LTC policy, but they can from Nationwide because we provide cash. Informal care, unlimited home modifications, future technology that has to be invented to keep people in their homes longer. It's not a question of if. The answer is yes, you can use the benefit however you want. And that is where we hang our hat. That's why we got in the market 20 years ago. And we're seeing now a evolution of these products. So what we did is we built a traditional long-term care policy. We already had a rider on life insurance, but what about a client who's primarily looking for long-term care? We built what looks like a traditional LTC policy, but we guaranteed the premium. We made it so the client can't lose money if they don't use the LTC. All that money comes back in a death benefit. So it's not use it or lose it. We added inflation options, kind of like a traditional policy. And we also offered a refund of premium. You can choose to have it or not. It's about 10 to 15% more expensive, but you could cancel and your client can get all of their money back after either 5 or 10 years. The other thing we did last May with this product is we made the elimination period retroactive 90 calendar days. So our rider and CareMatters is 90 calendar days, meaning every day counts, where most contracts are service days. But what's a service day? A service day means you have proof that a licensed person provided your care. Now, when my grandmother got sick, my mother was there 7 days a week. That's 7 calendar days, but the nurse was only there 3 days a week. So how long would it take to meet 90 service days? Much longer, right? You can do the math. It's over 6 months. So here with Nationwide, it's simple. The product works the way your client thinks it's going to work. It's cash. It's 90 calendar days. It's not use it or lose it. The premium's guaranteed. And by the way, we did one other upgrade. Everybody see the middle at the bottom? It's now retroactive. We'll go back and pay the client for the 3 months they missed. Now that's only on CareMatters too, not on our rider, but it's a retroactive elimination period. The client will get 4 months of benefit in month 4 to pay them back for the 3 months. It's not a reimbursement of expenses. It's just 4 months of benefit paid in cash in month 4. We did make new payment options from an affordability standpoint. We can now do not only a single payment and a 5-pay and a 10-pay like before, but we can now do a pay to 65 and a pay to age 100 to make it more affordable for more people. And then the last one on the bottom right, what I want to spend some time with you today on is separate identifiable premiums. What does that mean? Well, we separated the premium so that we could identify what is life insurance and what is long-term care. And by doing that, we created tax deductibility that you cannot get on an LTC rider on life insurance. If you buy an IUL or a no lapse guarantee UL with an LTC rider, although it's tax qualified and it pays out tax free, you can't get a deduction on the LTC because it's not an LTC premium. It's a long-term care rider charge, and that doesn't count. So what we did is, instead of deducting from the cash value the LTC cost, like on CareMatters 1, for CareMatters 2, we separated out the LTC altogether and made it its own separate premium. And it gets the same tax deductibility treatment and advantages as traditional long-term care. So the only thing left, when CareMatters was built, why buy a traditional policy? Yes, they're cheaper, but they're cheaper for a reason. But if Nationwide's going to guarantee my premium, give me a death benefit if I don't use it, make it cash, well, why would I buy traditional? Well, I can get a tax deduction. We brought that tax deduction to CareMatters too. I'm going to go through some examples of that in a minute. The underwriting, especially with COVID, we're seeing the spikes. We're all sick of the regulations, but understand them. And, there's different opinions there, but it doesn't really matter. At the end of the day, we cannot, and we're not living in the same place we are 6 months ago or 5 months ago. The world has changed, and that has caused some challenges for the insurance industry. Now, the good news is we haven't seen a slowdown. We're selling more long-term care and life insurance than ever before. Clients almost needed this to happen to wake up and say, yeah, I need to be protected. Now's the time. But from an underwriting perspective, how do you get a paramed exam and records and things like that? CareMatters has always been a simplified, streamlined process. No doctor, no paramed exam. I'll say it again, no paramed exam, no blood, no urine. This is designed to make an offer in 3 days. You get the application submitted and set up the interview, and we make an offer in 2 to 3 business days. Now, the client has to be healthy. We cannot try to get unhealthy people that aren't insurable through it. But if your client is healthy, this is a faster way to get to that offer. It's an interview. It takes 45 minutes to an hour on average. It's a whole bunch of questions, mostly yes, no. But by the end of it, we have everything we need to make an offer 95% of the time. Or to know that they're going to be a decline, and we'll let you know that as well. 5% of the time, it's borderline, and we will request medical records. But our standard process is not to go for records, and we don't ever require a paramed exam. It's just a phone interview. I will send Jimmy, he'll give it out to the team. There's a phone number you can call to pre-screen your clients. There's a worksheet with uninsurable medication and conditions that you can use to pre-screen your client to see if they're a good fit. And there's also a worksheet that your client can fill out before the phone interview. We don't require that worksheet be turned in. Please make sure every client does the worksheet before the interview. It will create a better experience, a shorter interview, but it also is going to increase the chance that they get approved. How could that be? Because if we ask them, do you have type 2 diabetes, and they say yes, and our goal is not to go for records, but they don't remember their last A1C score, or they didn't look it up, so they try to remember and they say the wrong number, they might end up getting declined. Or if they're prepared and they have the information, we can make that offer in 2 to 3 days. So fill out the worksheet. We'll get that to you. That's everything I want to touch with on underwriting. If you have questions, type them in, or we'll open it up at the end, any underwriting questions. Separate identifiable premiums. A lot of information on the screen. Don't read ahead. It'll just confuse you. It confuses me. But what I do want you to see is these 4 boxes at the top: life insurance, the LTC rider, the extension of benefit, and the inflation. Now, your client's writing one check. It's one check. Maybe it's $10,000 a year in premium. Depends on what they want to buy. But that $10,000 a year, we're going to look at it as 4 different premiums. Part of it was life insurance. Part was the LTC rider. The extension of benefit is the LTC above and beyond the death benefit. So why would somebody buy CareMatters and not just the rider? CareMatters pays more LTC than just the death benefit. That's the advantage there. Also, it has inflation, so the LTC can grow, another unique feature. Those three charges on the right-hand side are potentially eligible for a tax deduction, but there's a limit. So at the bottom of the screen, everybody see the IRS limit based on the age. So if you're young, it's not huge. I don't lead with this with a client. It's kind of a, by the way, you're going to happen to get some tax deduction on it potentially. But if I'm 51 to 60, I might get 1630. If I'm 61 to 70, it's as high as 4350 in 2020. These are the IRS limits on how much of the LTC premium can be deducted. What deductions are there for an individual? One, I like talking about. The other one, I not as often. So I'm going to start at the bottom where it says HSA distribution. This one I do like talking about. Clients that have a health savings account. Jimmy and I both have a health savings account through Nationwide, part of our health insurance. Many clients do now on a high deductible plan. The money that I put in there is pre-tax. That's important. That money has never been taxed. The goal is to get that money out without ever paying tax. It's one of the greatest tax advantages you can find. An account that's tax deferred and can be taken out tax-free. The only other thing I know close to that is an IUL. So I'm going to put the money in tax deferred, not pay tax on it. The company matches some of that for Nationwide. And as long as I can prove qualified expenses, I can take a reimbursement and get that money out tax-free. That's the goal. Well, we can take up to these limits at the bottom of the screen for the LTC premium. I can call my HSA and say, hey, I have documentation. I spent $1,630 this year on LTC premium. Send me a check. So I'm paying out of pocket the full premium, but I'm going to get reimbursed for some of that money. Another advantage with an HSA is called shoeboxing, if anybody's familiar with that. It's the idea that just because I can be reimbursed doesn't mean I want to be. I have a receipt and I can get that money out tax-free. But what if I left the money in the HSA, let it grow because it's invested, but I just hold on to that receipt. I save it for later. You don't have to take the reimbursement in the year you have the expense. I can wait till I'm 60 and retire and then send all my receipts in and take the money out later. So the idea of collecting all the receipts in a shoebox. Now, bottom of the screen, it's very small fine print. Nationwide nor its affiliates give tax or legal advice. Anything I'm sharing with you cannot, should not be implemented without a tax advisor. But I'm giving you the information that that tax advisor would want to know in order to look at it and say, yes, okay, let's do it. The federal tax deduction at the top, this one is the one that would get the most use if the IRS didn't restrict it. But the IRS only allows you to deduct for a federal tax deduction medical expenses above a certain percentage. Right now it's 7.5%. In the past it was 10%. Next year it's likely to be 10% again. But let's just say it's 7.5 and it stays there. It doesn't matter. I can only take a federal tax deduction for medical expenses above 7.5% of my adjusted gross income. If I make $100,000 this year, anything above $7,500 would be deducted if I itemize. So let's say I do have exactly $7,500 in out-of-pocket medical expenses. I had surgery and it cost me $7,500 out of pocket. Well, if I also have LTC on CareMatters 2 and I'm 51, $1,630 applies as a medical out-of-pocket expense. So these same limits at the bottom can count towards that. So if that puts me above 7.5, anything above 7.5, I'm working with my tax advisor and I'm taking that deduction. Now, if I'm sitting in your shoes, I'm going, all right, HSA makes sense, but the federal tax deduction, I don't even know if I want to bring that up. And I agree with you, probably not. So why would we share this with you? Why is it exciting? Because everybody on this call can take it without a 7.5% floor as a guaranteed deduction, even if you don't itemize. Every restriction the IRS has on this that's making it difficult, we can remove. Now, we still have the same limits at the bottom of the screen. How do we do it? Well, if we have a client that has a pass-through entity, LLC, S Corp, sole proprietorship, and we run that premium through the business instead of out of our checking account, now I'm going to pay income on it. So if the LLC writes $10,000 a year check to Nationwide for the payment, I'm still going to report $10,000 of income, but I get to file business expenses. So a lot of you on this call probably set yourself up as an entity, and every year you file a K-1 or a Schedule C, and you're listing your different business deductions. Are you aware that you can take LTC premium as an out-of-pocket healthcare expense up to the limits right here under 2020? So if you're 51 to 60, 1630. If you're 61 or up to 70, 4350 as a guaranteed business deduction for any LTC premium. That doesn't count for cash value LTC rider charges. So again, this isn't the rider, but CareMatters 2 LTC premium or traditional long-term care policies, you could get a business deduction. Many of you work with clients that own a small business. If you're a sole proprietorship, by definition, you are a pass-through entity. You are set up as a business. You're a 1099 employee, you can do it, but you probably have to reach out to the county, set yourself up with a tax ID number for the business. But it's possible, right? But thinking about clients who owns a small business, there's no 7.5% floor. And even if you make too much that you would not itemize, it's an above the line deduction. Above the line means you get it regardless if you itemize. You can also include spouse and children when you get that deduction. So your spouse, your children can purchase a CareMatters 2 plan, and then based on the insured's age, that's how we're getting the deduction. For C Corps or for employees, it's different. That's called an exec bonus plan or exec carve out. It works different. I'm not going to talk about that today, but if you do work with exec bonus plans, if you've ever set those up, reach out to me because there's a much bigger deduction you and I could talk about.